Today we're going to talk about the 7 rules to live by for retirement success in this episode of 50 Shades of Money.
Are you confused about your money? We find most retirees are. Jim, we see so many retirees come into our office and they are afraid, they're scared, they don't know what to do with their money, they're afraid it's going to run out, they're afraid of big losses, they're afraid of so many things. And they're looking for guidelines, they're looking for a roadmap. Of course, guidance, but more so they want guidelines and roadmap. They want rules. And if you give them rules, we find they will usually play by those rules. What we created to make sure that retirees can have a successful retirement is what's called our 7 rules for retirement success. And imagine if you could actually follow 7 rules and it would virtually guarantee your retirement success, most retirees would follow those.
Absolutely.
So what would be the #1 rule out of 7?
Avoid losses, period. When clients come in, you and I know, we analyze their portfolio and we usually determine they have substantially more risk than they ever thought they had. Our rules at our company, and this starts from the very beginning of the relationship, is we end up developing a portfolio that has no more than 5 to 10% loss potential, not 30, 40, or 50% when the client meets with us. Making up a 5 or 6 or 7% loss in a major market crash of 50%, we can do that. Trying to make up a 40, 50, or 60% loss, not going to happen unless we're flat out lucky.
Well, that's because you explained before in previous videos that if someone loses 50%, you have to make 100% just to get back up to even, and we never want to promise 100% return to anybody.
So Dan, what's another reason that you can think of that would help clients build or follow these 7 rules?
Well, the second rule, Jim, is to minimize fees. And to do that, you have to first understand your fees, then you have to control and manage those fees. That allows you to minimize fees. We find almost every retiree thinks they're paying about 1% in fee, when in reality, once we do a thorough analysis, we use sophisticated software to calculate out how much they're actually paying in fees, and we find clients paying 3, 3.25, 3.5, 4, 4.5, even 5% and higher in fees sometimes. That's going to decimate their portfolio, so we have to help them reduce the fees. When we design one of our conservative asset allocation models, they're typically going to be total fees anywhere from 0.75 to 1.25. That's great because we've significantly reduced their total fees they're paying on their monies, and now they don't have to worry about that section. What's a third rule we need to live by, Jim?
The third rule is to significantly reduce volatility, because volatility is risk. And clients don't understand it. They think because they have a diversified portfolio that the risk is reduced, and that's not true. There are very specific strategies, rules, products that we use in order to reduce that risk to that 5 to 10% level.
Well, if someone has taken income from their portfolio now and there's a lot of volatility, can they take a high level of income consistently off a volatile type of portfolio?
Not off a volatile type portfolio, because if you lose half your money and you're taking out the same amount thereafter, you're going to run out of money very, very quickly. So our goal is to make sure that we understand what the client is trying to achieve from an income perspective and develop the portfolio ground up so that it will not lose very much in another market crash. Okay, Dan, what's the 4th rule?
4th rule, Jim, is to make sure you try to earn a reasonable rate of return. Stop trying to get the highest rate of return, because what usually happens when you try to get the highest rate of return, do you get the highest rate of return or do you lose a lot of money? Most people in the United States have found the higher rate of return they try to get, the bigger loss they end up suffering. So you're no longer what we call a stock jockey. You're no longer 20 or 30 years old if you're watching this video. You're retired. You can't take those risks any longer. So you have to earn a reasonable rate of return. You can't keep checking your phone every 2 minutes, verifying what did my stock do, what did my stock do, what did my stock do, driving your wife crazy. You have to stop doing that. You have to earn a reasonable rate of return. Remember, the stock market's only averaged about 3% per year for every 15-year time period over the last 20 years. 3%. So for you to think you're going to get 6, 8, or 10, it's just not going to happen. So focus on getting a reasonable rate of return while reducing your risk, and you'll be in a lot better position. What's number 5 as far as a rule we need to follow?
You know, everybody's concerned about taxation, so our job as an advisor to our clients in retirement is to manage taxation efficiently, and that's exactly what we do. Again, we use very sophisticated software. That software allows us to template exactly what that client's going to pay in taxes on every asset class, or I should say every income source that they have in retirement. So we can actually demonstrate that for them exactly for the next 12 months what their taxation is going to be on each one of those income sources, and we can dial it down if they want to pay less taxes. And it's really important for them to see that on paper, because then they're comfortable in spending their money in retirement, and that's why they save their money.
Well, we've found that hardly anybody understands taxes. Last week we did the calculation for your really nice client that came in. They had about $120,000 of gross income now. They wanted to boost it up to about $160,000, but they were afraid of taxes. Literally deathly afraid of taxes. We said, don't worry, let us do a calculation. When we did the calculation, we found out they were actually at an effective 14% federal tax bracket on their $160,000. They no longer were afraid, and they were so happy because now they got to use their money without worrying that Uncle Sam was going to take such a big chunk away from them. And they ended up being just great clients. They love the program, and it's going to work because they're not worried about taxes anymore.
That's right.
And Jim, that brings us right into the 6th rule, and that is you have to have a written comprehensive retirement income plan. When new clients come in, we ask them to see their plan, and they might have had an advisor for 10, 15, or 20 years. None of them have a written plan. They'll try to hand us their statement, and we'll say, well, that's your statement of your portfolio, but that has nothing to do with your written plan. So you have to make sure that you have a written retirement income plan. Well, what's consisting in that type of plan? You have to make sure you have a retirement income projection that'll show every year how much income you're going to get throughout retirement. Each year it'll show how much income you're going to get from each source, when each income source starts, stops, increases, and decreases, what's guaranteed and not guaranteed. Think how comfortable you would feel if you had that type of plan right now that you can look at. You know where your income is going to come from. Then you have to do a complete tax plan to show how much tax you're going to pay each month, what your overall tax rate is, so the client can feel comfortable knowing they're not going to get killed with taxes. We have to have an asset beneficiary transfer analysis that'll show what can be reasonably expected to leave to our kids after we've taken all of our income out. And we want to then wrap it up with a total written plan, anywhere from 10 to 24 pages, that details every single aspect of your retirement, the advantages, the disadvantages, costs, the fees, when you're going to use each asset, how everything works and tie it together. Now you have a true written retirement income plan. And I think then that ultimately focuses and wraps our hands around number 7. So what's that rule?
The 7th rule, Dan, revolves around what clients are looking for when they come into our office for the first time. They want to know exactly what income is going to be generated for them in their retirement. And they only have 2 choices. That's quite simple. You can have maybe income. That's income that comes off your portfolio. It can be your interest you're earning off your assets, your dividends. It could be the growth you have in your portfolio. And that's fine. It's called maybe income. It can go up, it could go down, because it's maybe depending on market conditions. Or you could have certain income. And this income is certain. It's going to be there every single year for the rest of both spouses' lives for as long as they live.
Let me ask you a dumb question. If you ask someone whether they want maybe income or certain income, what are they choosing?
Certain income, of course. They don't know what it is, and that's our job to explain it and to develop a portfolio correctly.
So Jim, with these 7 rules, if someone could do all 7 of these things, which most clients don't know they can do all 7 of these things, but imagine if you could do all 7 of these things, every single retiree is guaranteed to increase the probability of retirement success if they can do these 7 things. And we guarantee you can do all 7 of these things if you just create a comprehensive plan. It's not an investment, it's not a product that everyone tries to sell you. It's by completing a plan, you can do all 7 of these things. Now imagine if you had all 7 of these things completed for you. You avoided losses, you minimized fees, you reduced your volatility, you earned a reasonable rate of return, you minimized your taxes, you had everything in writing, and you had certain income versus maybe income. How would you feel going through retirement? That would give you the most secure feeling. Anxiety would be lessened, concern, fear would be lessened, and you'd then have a very successful retirement.
If you like this video and want to create your own retirement income plan, we've just created a brand new video that will walk you through this process. All you need to do is click the link below and we'll send that video to you.